You know, they sometimes say you can't pick a good year to take over. So I think that it has really been a bit of a fiery one from that perspective. Certainly, we've seen world economic markets remaining in turmoil, increasing throughout the year. That's obviously rattled every balance sheet in the world. We've talked recessionary talk we've had. We're speaking about disposable income of clients actually reducing during this period of time. But if I take a step back and I look at Metropolitan, we've, during this period of time, grown net cash flows into our business by 8 billion. We've got 8 billion rands more money from our customers into our business. We've grown our retail new business. Our persistency has held up well. We've done well in some of our international territories. I think our health business particularly performed well. So if I look operationally, I'm very happy with the performance of the team. Certainly when we take a step back and look fundamentally at the earnings levels, those numbers are probably below what I would have wanted at the beginning of the year, but that's largely impacted by the market, and we've, as many other financial institutions, have taken that mark-to-market position down in our shareholder funds, which mostly were invested in equities at that point in time.
Metropolitan has produced a set of solid results today with notable success in your new business unit, particularly in your new insurance business, seeing a rise by 38%. How has Metropolitan been able to achieve such a sizable growth in a much tougher trading environment?
The retail side focused a lot on actually making the sales channel very efficient. So it's about channel management. We've got almost 2,000 agents in South Africa specifically. Those agents are managed down persistency, production, type of production, by product line, almost by day. So it's a strong look at that, using that information to actually make sure we get quality new business on book, making sure that we, of our almost business intelligence that we have, that we actually put back into our product offering to the clients, so we stay and use our Metropolitan brand to stay closer to our clients. So on the persistency front and the new business front, and to some extent that value was largely assisted also by a change of new business mix. So we killed some unprofitable product lines and rather enhance our effort on the profitable product lines, which hopefully also align with value for money for our customers. And that's just an unwavering focus that we've had during the year. For 2009, that will have to continue because we pretty much see similar conditions in that space for the year ahead.
There's also some relative good news for your shareholders today because your total dividend remained flat at 95 cents, showing strong resilience from Metropolitan. What's been Metropolitan's resilient strategy in these tougher economic conditions?
Well, maybe just on the dividend, I think it's an important indicator for shareholders. The board deliberated on it long, but in the end, I think it shows a very confident sign in the business's cash generating capability, in our capital position. But at the same time, the fact that it remained flat shows a little bit that the uncertainty of 2009 will prevail. It's not just a bump in the road that we are getting at the moment. I think from an overall economic perspective, it will remain in place. Some of our defensive strategies has really been curtailment of expenses, curtailment of some expansionary thinking, really de-risking a lot of our asset portfolios. Our shareholders' capital have moved much more into a defensive strategy with downside protection. So almost on all fronts, on the operational side and also on our investment side, we have put in measures to actually weather the storm better than we would have otherwise without management action.
In light of the global credit crunch, many life insurance companies are curtailing international expansion in favor of consolidating their local business units. But in the case of Metropolitan, your international units, and particularly those on the African continent, have delivered quite a strong performance.
Yes, our international strategy is almost two tails in there. There's our near neighbors, which are generally mature markets. We've got either number 1 or 2 positions, so we've got dominant positions in those mature markets. And there the strategies are much more around consolidation and focusing on getting to your client and retaining your client. And we've got 3 expansionary type businesses in Kenya, Ghana and Nigeria. Those are more front foot, almost offensive strategies that we do have for those businesses. They are still in the development phase. It's early days, but certainly the West African operations for us have shown good new business growth. I think there'll come a time when we'll have to reinvest in those businesses just to support the infrastructure growth there. And those are all investments that we're happy to make. Specifically Kenya for us is still, we found East Africa a little bit more of a difficult market to open up. And we still need to resolve that. But certainly West Africa is very attractive for us at the moment.
How strong is Metropolitan's capital position? With liquidity being a problem globally, is your capital position strong enough for these volatile markets?
We've got statutory capital requirement, just about 2.4 billion rand. We've got at the group level free capital of about just over 7 billion rand, so giving us a capital cover of 3.1 times at group level. And I think that's a very healthy position. I mean, under current circumstances, we've seen balance sheets all over the world, very volatile in their own right. Companies talk about bailouts, etc. From Metropolitan perspective, we are very confident that our capital position is secure. Our capital is liquid to a very large degree. So if we do need to go onto the front foot again and be more expansionary in our business, we can do. But at the moment, we have curtailed many of our activities to actually focus and consolidate through 2009 and make sure we make the right decisions at the right time during this year.